Commercial banks create most of the money used in the modern economy. We are going to see how the commercial banks create new money in the economy through an accounting process called balance sheet expansion. Examples of commercial banks we have in Uganda include Stanbic, Standard Chartered Bank, Centenary Bank, Equity Bank, DFCU, Absa Bank. There's so many banks. In countries like the United Kingdom, the United States, and similar developed countries, commercial banks create more than 95% of all money in circulation. In developing countries, the amount of money created by central bank is significantly more, partly because people use a lot of cash in the transactions. They can create up to 10%. Central banks can create up to 10% of all the money and can even go as high as 20% of all the money supply. Then commercial banks create like 80% of the money. It varies between countries, but the ranges are higher because in highly developed countries, the amount of money created by central banks can be less than even 3% when the 97% is created by commercial banks. Like the Bank of England usually says that about 97% of all the money in the UK is created endogenously by commercial banks, and the central banks create about 3% of the money. Commercial banks expand their balance sheets and create new money. They put loan assets on the asset side of the balance sheet, and they create new money on the liability side of the balance sheet. Generally, an asset is anything which you have rights to and you can sell it to other people to convert it into money. A loan asset is something which you give to a bank in exchange for the bank to give you a loan. Let us use an example of Samuel, who has a 10-year job contract with an organization with which has a good reputation, and he wants to get a 5-year salary loan. He wants to get 100 million, and he wants to pay that loan in installments for a period of 5 years, and the bank is giving him 100 million. Samuel signs the loan contract with the bank, pledging that he will pay the 100 million over 5 years with deductions from his salary. And his employer as well signed the commitment that in the next 5 years, all Samuel's salary will be channeled through that bank. The pledge of Samuel to pay 100 million to the bank plus interest over a period of 5 years is an asset to the bank. And actually, the bank, if it wants, can even sell that asset to other banks. Like, for example, the bank can choose to sell that loan asset to another financial institution or bank in exchange for money. And therefore, after that, all the money which Samuel pays plus the interest is channeled to that other bank. Let us continue to see how banks create new money through balance sheet expansion. When Samuel completes signing the 100 million loan application, the bank receives it as a loan asset from Samuel, and it puts it on the asset side of the bank's balance sheet. Due to the double entry accounting rules, when you record amounts on the asset side of the balance sheet, you have to record equal amounts on the liability and equity side of the balance sheet. Therefore, after recording a 100 million loan asset on the asset side of the balance sheet, the bank also records a 100 million pledge to give Samuel 100 million on the liability side. And that pledge is actually new money created. When Samuel checks his account balance, he will see a deposit of 100 million on his account. However, it is important to note that this 100 million bank pledge is not other people's savings. It is not central bank money. It is simply a record of the commercial bank's pledge to give Samuel 100 million. And that is credit money. That is how endogenous money is created. That is how most of the money in the world is created. In simple terms, bank deposits are just bank pledges to give a person money when they need it. The commercial bank is not required to have other people's savings which are equivalent to the pledge it makes. What the commercial bank is required is that the loan asset which is on the balance sheet is credible enough and equivalent to the pledge it has put on the liability side, and that pledge is the bank deposit. Central banks normally put reserve requirements on commercial banks. For example, a 10% reserve requirement. This means that if a commercial bank creates deposits, say of 100 million, it should acquire central bank reserves of 10% of 100 million, and that is 10 million. Central bank reserves include the digital money which commercial banks acquire from the central banks as reserves, also the cash reserves which the commercial banks have. In case the reserves which a commercial bank has are less than the 10% reserve requirement of the deposits it has created, then the commercial bank has to go to other banks which have excess reserves and borrow from them or borrow from the central bank. It has to meet the reserve requirement obligation. In this case which we have discussed here, we have used 10% reserve requirement. Banks first create deposits and then they balance the reserves after. Therefore, on confirming the 100 million loan asset on the bank's balance sheet, the bank immediately writes the liability or the pledge to give Samuel 100 million. And that record is a bank deposit or credit money, and it's how money is created. And when Samuel checks his bank account, he sees 100 million when it's actually just a bank record. That's how money is created. If, for example, we know that Samuel has bank deposits of 100 million and he wants to buy a car from John, who also has an account in the same bank, what it does is it simply transfers the 30 million to John's account. But in the background, what the bank does, it reduces the pledge of giving 100 million to Samuel, it reduces it to 70 million, and then it increases the pledge of giving money to John by 30 million. So on John's account balance, it reads that he has 30 million, and on Samuel's account balance, it reads that he has 70 million. If Samuel wants to withdraw cash from the bank, or if he wants to transfer money to another account in another bank, in a different bank, that's when central bank reserves come in. Let's suppose that if Samuel still had 100 million on his account and he wanted to withdraw 30 million cash so that he buys the car using cash. This is what would have happened. He would go to the bank and the cash would be given to him, and the account balance on his account would reduce to 70 million. On the bank's balance sheet, it will look like this. On the asset side of the balance sheet, the bank's cash holdings would reduce by 30 million. And on the liability side of the balance sheet, the pledge to give Samuel 100 million will reduce from 100 million to 70 million. That's why when Samuel checks his account balance, he will see 70 million. Let us look to another scenario, like in case Samuel still had the 100 million and he wanted to buy the 30 million car from another person, but when that person has an account in a different bank. So what Samuel would do, he'll just make a bank transfer from his 30 million from his account to the account of the person who is selling the car in a different bank. Now when that person checks his account, he will see 30 million account balance, and when Samuel checks his account balance, he'll be left with 70 million as account balance. So now let's also look at what actually happens in the balance sheet and how that happens to be. On Samuel's bank side, what happens? Let's see what happens on the balance sheet. The central bank reserves, which that commercial bank has, are reduced by 30 million, on the asset side. And on the liability side, the bank's pledge to give Samuel 100 million is reduced by 30 million to 70 million. And this what happens. The central bank reserves, which were reduced from Samuel's commercial bank's asset side and are then transferred by the central bank to the other bank. So the central bank reserves of the other customer's bank increase by 30 millions. And what that other bank does, it increases their liability side by 30 millions as well. So it pledges to give that person 30 million. So when that person checks his account balance, he sees 30 million. That's why central bank money is called settlement money. It's the money which commercial banks use to settle obligations among themselves. Although commercial banks can create bank deposits, they still need central bank reserves. They need central bank reserves for 3 reasons. First, the customers who have bank deposits may want to withdraw cash, and for that they need the central bank reserves. Then secondly, they may need to transfer money to other commercial banks, to people in commercial banks with different accounts, and there they also need reserves. Also, the third reason is the rules and regulations. Sometimes they require a minimum amount of reserves which each commercial bank should have for liquidity purposes. So for those reasons, commercial banks still need the central bank reserves, the central bank money. The central bank supplies reserves, acts as the lender of last resort. It supervises the commercial banks. It ensures that there is the confidence in the banking systems, in the bank deposits.